Good morning, everybody, and welcome to this Wednesday, December 11th edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. A couple of things I just want to mention before we get going. I'll go ahead and show you where you can sign up to the Market Vision 2020 event, which is going to be held on Saturday, January 4th. If you go into EarningsBeats.com and you head to the top of your screen, there will be a tab for Market Vision 2020. You simply click on that, and there you go. You can sign up with your name and email address. It is free to subscribe to the newsletter, and you'll get a lot of fun facts about the speakers. We got mini-series events that are free to anyone that is signed up leading up to the main event. The main event, of course, you will have to register and pay for, but it is very affordable, and we do have an early bird special going right now that you don't want to miss. So make sure you sign up for that. This Friday, our next mini-series event will feature Greg Schnell, a great friend of mine, also a colleague at Stock Charts. Greg specializes, he lives in Canada, specializes in a lot of the resource stocks up in Canada, and of course follows the U.S. market overall as well. I think you'll enjoy listening to Greg on Friday. So please just make sure you come in here and sign up. Again, it is free. Name, email address, and you'll get a lot of information about the upcoming event, and we'll keep you posted as news unfolds there. The other thing it does is we're going to have a special event on Monday. And John Hopkins, my partner, and I, we've been talking about, the fact that the environment now for trading has improved so much. We've got online brokers now with no commissions. That means a lot in trading. And I haven't focused on it enough. And I think it's worthy of a special event. So we're going to talk about it on Monday after the market closes. It'll be around 4:30 Eastern. We'll be sending out information to anyone who has signed up to the Market Vision 2020, anybody who has signed up to the EarningsBeats Digest, which is a free newsletter. You can go right up to the top to free newsletter tab. You can sign in there. And also, obviously, to all of our paid members at EarningsBeats.com. So it'll be another community event. We want to talk about these free online commissions and what that means to our trading, not just our individual stock trades, but also if you want to take advantage of the portfolios that we have at EarningsBeats. I think it makes a lot more sense now if you have a smaller account, not having to worry about commissions. So we'll talk a lot more about that on Monday, but just make sure you're signed up into the EarningsBeats Digest to the Market Vision 2020, and you'll hear all about it. All right, let's move on to what's going on here in the market, or what went on in the market yesterday. Overall, it wasn't a bad day. We did pull back. I'm not shocked. I've talked about this quite a bit recently, but this is the time of the year when we tend to struggle. I mean, the market from the 6th to about the 15th, that is the worst period of the month. And even the Russell 2000, which if you go back to 1987, has an annualized return in December of about 28%. That's pretty strong when you consider you put all the Decembers together for the last 32 years. But the interesting part is from the 7th to the 15th, it's actually a negative. I think it's 12% annualized return. So if you take that out, you can imagine what the rest of the month typically looks like. Normally, the beginning of the month of December is strong. And if you look over here at this the S&P 600 small cap, you can see the early part of December, just like history tells us, moving higher. Now we're into the period where we tend to go sideways to down. That's what we're doing. When we get past the 15th, this is one of the most bullish periods of the year. I would actually argue that it is the most bullish period of the year because it stretches for about 15 days and has tremendous annualized returns. So I think that we've got some brighter days ahead, but we do need to try to get through the next week or so. The Dow Jones, you can see yesterday, was down 27 points. The S&P down 3 and change. The NASDAQ was down about 5 2/3, and a very slight move to the downside on the S&P 600 small cap index. And this is what we've been seeing. We've been seeing a little bit more outperformance by small caps. And again, that has been the tendency in the market for the last many years. Small caps tend to outperform in December. 10-year Treasury yield, you can see down just a little bit, 1.83%. It's down less than 1 basis point today. So not really doing a whole lot, just simply moving sideways. Got an interesting chart I'll show you on the 10-year Treasury yield in just a bit. As far as the sectors yesterday go, healthcare was the leader. Didn't really move up a lot. In fact, most of the areas of the market were very close to the flat line. Healthcare up 0.22%. Energy up 0.20%. I don't have it shown here, but I think technology was next in line, just up barely. As far as individual stocks go, Autozone came out with its earnings report. Big gap up. The stock did break out above some sideways consolidation, and it was the best performer in the S&P 500. Real estate, not doing so well short term. I'm not a big fan of real estate going forward. If you study the history of the market, if you truly believe in the secular bull market theory and the fact that we could have a really strong 2020, defensive groups tend to lag. I do think they'll go higher. I just don't think they're going to go up nearly as fast as some of the more aggressive areas. So for me, real estate is not something I'm really considering. Could there be an outlier here or there? Yes, always. But just knowing that I'm expecting underperformance in the group, it's probably not going to be an area I'm going to spend a whole lot of time on. As far as an individual stock within the S&P 500, not having such a good day yesterday, got to point out Netflix. It was downgraded. Stock broke back down below its 20-day moving average. Had a little bit of an uptrend that it looked like it was moving. I had issues before, though, when we did break above that 310 level. That was good news from a price standpoint. But look down here at the volume. There was just no volume to support that breakout. That means that if it does fail to hold that breakout level, you don't want to be in it. I think Netflix is moving lower. It's a great company, but I just think that it's got a lot of headwinds right now. It had moved up a lot, and it's just simply in a consolidation mode until it has something on its chart, some kind of character change back to the upside, and it begins leading on a relative basis. I would personally stay away from it. All right, the 10-year Treasury yield, we did have one economic report out earlier today, and that was on the CPI. It did come in just above expectations. It rose 0.3% for November versus the 0.2 expected. If we look at just core CPI, however, it was as expected, 0.2%. So it came in right as expected. As far as the chart here on the 10-year Treasury yield, the inflation report was kind of timely because I think what's going on here in the market, and I think this is really important, when you see the 10-year Treasury yield move down, a lot of times the initial thought is, my gosh, bond market thinks the economy is going to be weak. I think, well, there's two things that really go into the Fed policy statement, which will be announced this afternoon at 2 o'clock, by the way. They want price stability just as much as they want economic growth. So you have to understand that one big part of the Fed's mandate is to keep inflation at a target level or close to a target level. And inflation has been running below those targets. So there's going to be no need whatsoever to raise rates. And in fact, the lower expected inflation, that could put more pressure on the Fed to lower rates or at least keep them where they are. So even if we see strong growth, just like we saw last week with the jobs report, that doesn't necessarily mean the Fed's going to be raising. You've got to keep an eye on inflation. Inflation is running beneath their 2% target level right now, and I think that is going to keep them at bay for quite a while. Until we begin to see the inflation numbers really pick up, and I think we could see commodities and materials and energy do well in the market over the next several months because I do think we could see a temporary drop in the dollar, and that will likely lead to a little bit of an uptick in inflation. I don't think it's going to be enough, though, to threaten the Fed. So I think we're going to see a very low interest rate environment in 2020 and moderate growth, increasing growth, and that is nirvana for equities. I see a very strong 2020 ahead. When you look at this, though, and this is the point I'm making, the 10-year Treasury yield took a big drop in August. With that initial drop, you can see the S&P 500 dropped with it. But each one of these subsequent moves, 3 additional moves lower in the 10-year Treasury yield, and we did not see the S&P 500 drop any further. But yet when the yield rises, you can see when the yield rises here, you can see the S&P 500 rises with it. Then there's the drop. We come down, double bottom again, keeping the higher lows on both these charts. And now the yield seems to be back in an uptrend. And look at what has happened to the S&P 500 when we've just moved into what I think is just a little bit of an uptrend. We get a break up above 1.952%. I think you're going to see this S&P 500 continue to soar. So this is, like I said, it's really nirvana. When the yield goes down, the S&P 500 holds up pretty nicely. When the yield goes up, the S&P 500 takes off. And so let's watch the 10-year Treasury yield for clues as to the significance of the advance in 2020. I think either way, we go higher. All right, let's take a look at Netflix. Mentioned Netflix earlier. Let's pull up the relative chart. And this is the problem I have with Netflix. Yes, it had the gap up with earnings. I couldn't understand that. The numbers weren't that great. Came right back down and then went up and actually took out that high. Now, part of it is no doubt the internet space was going higher. Part of it, the S&P 500. Like I said, since early October, the S&P 500 has been going. So Netflix, I think, is just simply one of those cases where a rising tide lifts all boats. Well, I think Netflix has sprung a leak. Here you can see move back down to test the 20-day moving average with a downgrade. Yesterday, another downgrade, and the stock you can see breaking below the 20-day. But even worse than that is the relative strength. Versus the internet stocks, you can see it is down not far from a 52-week low. Same goes relative to the S&P 500. And yet internet stocks right now relative to the S&P 500 are at about a 3.5 month high. So Netflix is just not the stock in this space right now. It doesn't mean, again, that we're not going to see Netflix next year breaking out and being a leader again. But right now, as a short-term trader, I want no parts of Netflix. A couple of industry groups I'll take a look at quickly. I wanted to mention renewable energy, because when you look at renewable energy, you think, wow, this thing's really fallen out of favor. It's just going to continue going lower. On a daily chart, I would say, well, that could be the case. Just consider the fact that maybe, just maybe, we're printing a double bottom here near 100, and a break back up above 110 would confirm it. So keep that in mind. I want to move to a weekly chart, because while the daily chart looks absolutely horrible, the weekly chart, we had gotten way ahead of ourselves. We tried to make a breakout here in September with the weekly PPO finally rolling over, and that led to a centerline test of the PPO, and we're down right at about the 50-week moving average. Now, if we break down below 100 with some gusto, then I think we got some problems here, because you can see back here, when we lose that 50-week moving average, that can be a problem. So we're below the 20, but I think we're squeezing between about 100 and 110. Let's see which way breaks first. All right, let's move on to earnings. I want to go over a few of these earnings reports. First, Ollie's bargain outlets. Ollie's beat on the top and bottom line, and they are trading almost 10% higher today. So we may see a change in character here. 10% would take the stock up to about 66. I'd really like to see it open up above 67.5. That would be an initial signal that perhaps this downtrend, double bottom, all of this is over, and that we're going to begin to resume that prior uptrend. Ollie's was one of the best broadline retailers for quite a while. You can see that relative strength fell apart about 6 months ago, and it's been moving lower, but maybe we resume that strength after this blowout report they had. Next up, Play. This is Dave & Buster's. Another one that had been downtrending, sideways consolidating for a while. Stock beat top and bottom line. It's up 2% in pre-market. So I think this sideways consolidation, at least for now, continues. GameStop, GME. Oh, man, what an awful report this was. Horrible report. And you can see the stock versus its specialty retailers. Peers had been going down a lot all the way through August. It had tried making a little bit of rebound. Look at the volume, though, on the push to the upside. See the volume? There's just no volume to support this move to the upside. And here's the reason why. They absolutely came up a mile short on their earnings. Their revenues, $1.44 billion. They were expecting $1.62 billion. Bottom line, they lost 49 cents. The market was expecting a profit of 6 cents. Then they lowered their fiscal year 20 earnings per share. It was 115 to 130. Now it's 10 cents to 20 cents. This has to qualify, if not for the worst earnings report of the quarter, certainly one of them. Stock is down 18.6% in pre-market. I think we're going back down to challenge these prior lows. This is an awful report. I don't try to bottom fish, especially with a stock like this. I think the momentum is completely out of it. Nobody was buying this stock on this push back to the upside. I think it was simply market makers trying to get out of positions, probably for some institutional clients, and now we know why. AEO, they reported this morning an okay report. They beat on the top line, matched estimates 48 cents, but they came in and lowered guidance. And look at the chart. Stock's been going down, relative strength or relative weakness in this case, horrible. You don't want to be in a stock when you see the relative chart going like this. You don't want to be in a stock anytime, but especially into an earnings report, because there's a reason why it's underperforming. There's a reason why folks are getting out of it, probably because we've got institutions that have been bailing. And now we, again, get the answer. The numbers weren't that bad for last quarter, but looking ahead, fourth quarter earnings per share was supposed to be 46 cents. They lowered it to 34 to 36 cents. And their same store sales next quarter are supposed to be up 4.1%. Now they're saying flat. Stock is down almost 8% pre-market trade. So we are looking at probably at a gap down that breaks below these prior lows. You got a downtrend, a descending triangle, lower highs, equal lows. This is a bearish breakdown. Don't want any part of it. PLCE, Children's Place. They came up short on their revenues. They beat bottom line by a penny. They also lowered quarter four revenues and earnings per share. Look at the chart. Again, the apparel retailers have been going up. So if you've got a stock in the group going down, you can only imagine what the relative strength looks like. It's horrible. The bad news was already in the chart if you follow relative strength. Stay away. Last one, PLAB. Got to end with one that's a little bit more positive. They beat on their top line, matched their revenue, or matched their earnings per share, 15 cents per share. The stock is up 8% pre-market. And look at this one. This one actually had been, for the most part, moving higher in terms of relative strength for the past 5 or 6 months. So no shock here. It's in a good group in the semiconductor space. Looks like we're getting a nice breakout. This appears to be a nice emerging leader in the space. Two stocks that we're reporting after the bell today. Lulu's. Now look at this stock relative to clothing and accessories. I would be shocked, and I think Wall Street's going to be shocked unless Lulu comes out with a big report. I think you're going to see a beat on the top and bottom lines, probably a gap up, although sometimes when a stock's been up like this, you see a buy on rumor, sell on news kind of development, so be careful there. NDSN, I wrote about this one in the EarningsBeats Digest this morning, the free newsletter that I talked to you about earlier. You definitely go sign up for that. I mean, 3 times a week, I'm going to give you some really good information. But NDSN reports after the bell. Look at the relative strength here versus the industrial machineries. As it's made the breakout, I think the volume's been pretty strong. It's not a huge volume stock to begin with, so that might keep some folks out of it. It's probably borderline for me. I like to see a stock have average 200,000 shares. Sometimes during the year, it might be a little less than that. But recently, it just broke out. Look at these 3 days. Look at the volume spike. 3 days in a row as we make this breakout above consolidation area. That, to me, tells me there is some accumulation taking place. I fully expect this to be a good report. They missed their last 4 quarters on earnings. I'll be shocked if they miss this one. I think they beat. All right, upgrades, downgrades. Let's move on to WW Grainger, upgraded today. Stock moving up nicely, been in an uptrend. I think on a relative basis, you can see we did bottom all the way back here over the summer months, been moving higher as we head into the fall. I don't know. I don't think this one looks too bad. I think the upgrade here probably is warranted. Breakout above that 327, 328 area would be bullish. Gold upgraded. Now, this is Barrick Gold. This is not the price of gold. But Barrick Gold upgraded today. I'm not a gold fan, sorry. I think in the short term, gold will be okay because I do think the dollar is going to struggle for a few months. I just don't think gold's going to outperform the S&P 500. And I know when we ended Market Watchers Live, when I was doing the show over at Stock Charts, one of the last things we looked at was, what areas would be leaders going forward from, I think it was probably September when we were looking at this. And I said one thing you want to stay away from is gold. I just don't like it as a relative performer. And that's going to be the problem. And you can see here the gold mining shares moving lower now for the last 3 months on a relative basis. I think on a relative basis that continues, even though we might move higher in some of these stocks. I mean, I think gold, Barrick Gold could move up. Watch these moving averages and definitely watch these recent lows. If they go, I would not be in the stock. I'm not a fan. AEM, another one gold. And I think it was Barclays that came out with upgrades of these two gold stocks. Agnico Eagle Mines. The chart doesn't look too bad. Nice uptrend. Looks almost like a cup forming. Volume trends aren't too bad. You see on a relative strength basis, this has been one of the leaders. If I was going to be in gold, I'm going to go with one of the leaders. This is one of the leaders. I just think I'd watch maybe 56, 57 to the downside. If that breaks to the downside and you see volume picking up, I'd have to be out. Downgrade, WBA. Just wrote about this one this morning, and one of the reasons I wrote about it was I saw the downgrade. And I actually think it could be an opportunity. I think Walgreens Boots Alliance is a stock that had gapped up, very nice volume, coming back down, testing this gap support. And as I mentioned in my article this morning, if you look at the longer-term weekly chart, I think we've broken back to the upside. So watch, from a longer-term perspective, watch these moving averages. This is a perfect example of a stock that you can take advantage of the new no commissions on trades rules that you see among all the online brokers now. Because if you like the stock and you like it down to about 56, even if you're only going to put $500 into the stock, why not just put $100 in, buy 2 shares every dollar that it goes down for the next $3? You don't have to pay any commission. Before, that was impossible. It didn't make any sense. Even low commissions, the cost was too great. But now with the new environment that we're in, I think a stock like Walgreens, any stock for that matter, you can buy in small number of shares frequently. And I think it's going to increase volume in the market, number one. And the other thing I think we're going to see eventually is the ability to buy fractional shares of stocks. So you don't need $1,700 or $1,800 to buy Amazon. You'll be able to buy 1/10 of it for $170. All right, let's move on. I've got anatomy of a trade. I want to show you some of these trades that I currently own stocks. Office Depot. This is one I gave out to EarningsBeats members a couple days ago. I just like the fact it's been consolidating after the big move up. Look at the volume come in November. This looks like a character change to me. Downtrend turning into an uptrend. It's coming down. It's been holding this gap support. I think the combination of gap support and the 50-day moving average, which is now, that's 211, and the gap support is at 217. I think the combination there provides really good support with a target up near 260 initially. So entering from current price really down into the two teens, 215, 217, into that area I think makes sense. Watch the 50-day moving average and gap support. Whichever one's lower going forward, if it closes below the lowest of those two, I would be a little bit more concerned about this chart because it is a longer-term downtrending chart, so we don't want to see it roll back over. But, I mean, my strategy here, if this stock gets back up close to 260, I'll be out. And then I'll wait and see if it breaks out. Next up, Amcorp. When I went over the earnings and talked about the portfolios, this would have been back on November 19th. I pointed out that AMKR is one of my favorite stocks in terms of the earnings that came out. It was an unbelievably strong earnings report. And look at the massive number of shares that sent this stock higher from $11 to $15. The problem is you don't want to be the one that jumps in at 15 at the top. So you want to put these on a watch list and wait and wait and wait. I think from the 20-day moving average all the way down to this gap support level, $12.50 down to $11, I think is an accumulation zone. Will it get all the way to 11? We got to 11.50 and now we've started to turn back to the upside. Is that it? I don't know. I am into it. I'm into a partial position. I don't have a full position because I had some open orders down around the $11, a little over $11. But this is one that on weakness, I want to accumulate because I think eventually we're going to see it turn back up and go head back toward that $15 level. So buying it at 15 and watching it go to 11 and coming back to 15 doesn't make any money. But seeing it up at 15, showing patience, allowing it to come back to you around that 12 area, down to 11, I think could set up nicely for a nice trade. One more I'll show you, and then I'll move into the three you must see. This Deon Corp. I actually bought and sold this once already. It came down, hit $90 support, went up, hit resistance around 96. I actually got out and then reversed and went back down, hit 90 again yesterday. Actually went a little below 90. So I got back into it again. We'll see. I think the 50-day moving average is one level you could certainly keep. I'm not going to use this 84 gap support or 83 and change gap support. I think that's too far down for me. I am looking, I think off of all this volume right here, buyers came in around 87 to 90. That's a really good support zone on this stock right now. I think it turns back higher. My target, by the way, eventually would be 105. If I see it moving back up and I see some really good volume coming in, I'll hold it. If I see it moving back up like it did last week, where there was hardly any volume, I'll sell again, 95, 96. And again, these, even if you're only trading, $90, you don't have a commission. So you could buy at 90, sell at 95, make $5 for somebody who really, is just starting to learn how to trade. I mean, this online trading, this commission environment that's gone to zero is really benefits everybody, but especially those maybe who don't have as much to trade because the cost isn't as much. There is no cost. So you don't have to worry about that eating away at your portfolio. All right, let's move on to the three you must see. I'm going to start with a stock that I already mentioned earlier, and that's Autozone. I mean, this was a great earnings report. Sideways consolidation for a while, which I like. Nice base. They came out with their earnings. They beat top and bottom line, gapped up, very nice volume. It broke to a new 52-week high against specialty retailers. So I like that. Specialty retailers have been strengthening, although not breaking out. Certainly not one of the best areas of the market, as you can see down here. But it has been moving up, and you've got a leader with Autozone. So this one I think looks pretty good. And when we look at the weekly chart, it had a negative divergence here. See how it kept trying to go higher, and the weekly PPO rolled over? Well, we got back down, not to zero, but from 8 down to probably around 2 before we started to move up, and now the PPO is starting to turn up again. So I think AZO looks really interesting here. I'd feel better about it if specialty retailers were trending higher on a relative basis instead of trending lower, because you are trying to swim upstream. You got a great stock within the group, but it could be a little difficult. And maybe because you are in that weaker group, maybe we get a pullback to test the breakout level and maybe even a gap fill closer to that 20-day moving average. Looking at that candle, there's a lot of indecision after the gap up. So I think the odds are probably greater that we'll see a pullback rather than another big push to the upside immediately. So I'd have a little bit of patience here, but I think this one does go higher in time. Next up is Monster. Monster Beverage. Now you look at it, I saw that volume come in yesterday, and you can see, I think this was earnings related where it gapped up here and failed to make the breakout, went back down, held, look at it holding the rising 20-day moving average. That's the difference between a stock that is simply sideways consolidating and a stock that is now trending higher. So these successful tests I thought were really important. Now we're breaking out again. Look at the volume picking up, and check out Monster relative to the soft drink index. After trending lower for about 8-9 months, now all of a sudden we're at about a 3.5 month high, maybe even 4 months relative high to the soft drink index, and we're seeing volume coming in, and it's acting like an uptrending stock. So I think Monster looks really good. Last one I'm going to mention is Edwards Life Sciences, I talked about this one recently. I really thought that it would hold around this 230 level. We're just below that. Watch for a reversing candle. If we don't get it, pay attention, because big volume and now moving down to a relative, probably about a 3-4 month relative low, combined with big volume, combined with losing the 50-day moving average, we need a reversing candle. If we don't get one, I think we're going to run down to about the 210 area. So those are the three you must see for today. Appreciate everybody stopping by. Again, go to EarningsBeats.com. Sign up for the Market Vision 2020 newsletter. It's free. Sign up for the Earnings Beats Digest newsletter. Comes out 3 times a week. It's free. Try to give you a lot of really good information to help with your trading. Take advantage of it. Anyhow, everybody have a great day. We'll be back here at EarningsBeats.com for Trading Places Live next Monday. See you then.